Why do stock prices, mortgage payments, hiring plans, and the cost of groceries all seem to react when a central bank changes one interest rate? The common misconception is that interest rates only matter if you are borrowing money. In reality, interest rates are one of the main tools that shape inflation, jobs, and financial markets across the whole economy. An interest rate is the price of borrowing money, and from the lender's side, the reward for waiting instead of spending now. In macroeconomics, the rate people usually focus on is a policy rate set or influenced by a central bank. The exact institution, legal framework, and transmission mechanism depend on the country, so the details are not universal. But the basic idea is similar. By making short-term borrowing cheaper or more expensive, monetary policy tries to influence spending, saving, lending, investment, and ultimately economic activity. Start with inflation. Inflation means a broad rise in prices over time, which reduces purchasing power. If inflation is running too high, a central bank may raise interest rates. Higher rates tend to make loans more expensive, increase the incentive to save, and reduce demand in parts of the economy that rely on financing, like housing, business expansion, and some consumer purchases. When demand cools, businesses may find it harder to keep raising prices as quickly. That is one reason higher rates can help slow inflation. Now look at jobs. When rates rise, companies may delay opening a new factory, hiring more workers, or buying equipment because financing costs increase and future demand may look less certain. Households may also spend less if credit card interest, auto loan payments, or mortgage costs rise. If enough people and firms pull back, economic growth can slow and hiring may weaken. That is why central banks often face a trade-off. Raising rates may help control inflation, but it can also put pressure on employment. The reverse also matters. If inflation is low and the economy is weak, a central bank may lower rates to support borrowing and spending. Cheaper financing can encourage households to buy homes or durable goods, and it can encourage businesses to invest and hire. But lower rates are not a magic switch. If lenders are cautious, consumers are already overburdened, or firms are pessimistic, the effect may be weaker than expected. Markets respond because interest rates affect how investors value future cash flows. A cash flow is money an asset may pay in the future, such as bond interest, dividends, rent, or business profits. When rates rise, future cash flows are generally worth less in today's terms because investors can earn more from safer alternatives, at least in principle. That can put pressure on asset prices. Bonds are especially sensitive because their payments are usually fixed, though the effect varies by sector, company type, and market expectations. Exchange rates may move too, but that depends on many factors, including relative rates across countries and investor perceptions. Here is a hypothetical example. Suppose a central bank worries that price growth is too strong. It raises its policy rate. Commercial banks may then raise some lending rates. A household considering a home purchase sees a higher monthly payment and decides to wait. A business considering expansion sees a lower expected payoff after financing costs and delays the project. Demand softens. Businesses face less pressure to raise prices. Hiring slows somewhat. In this hypothetical, inflation may ease over time, but the cost could be weaker job growth. The exact timing and size of these effects are uncertain and can differ by country, banking system, and economic conditions. It helps to compare alternatives. Interest rates are not the only force shaping inflation and jobs. Fiscal policy, meaning government spending and taxation, also matters. Supply shocks matter too. A supply shock is a sudden change in the availability or cost of key goods or inputs. For example, if production becomes more difficult, prices can rise even without strong consumer demand. In that situation, raising rates might reduce spending, but it may not fix the original supply problem. Structural factors like productivity, labor force growth, regulation, and demographics also influence jobs and inflation over longer periods. There are also limits and risks. First, monetary policy works with lags, meaning the effects often take time to appear. That delay makes policy difficult. Central banks may tighten after inflation has already started to fade, or ease after weakness has already begun to reverse. Second, different parts of the economy react differently. Borrowers may feel rate changes quickly, while cash-rich firms may feel less impact. Third, expectations matter. If households and businesses believe inflation will stay high, controlling it can become harder. Fourth, financial stability matters. Very low rates for a long time can encourage excessive risk-taking in some environments, while very high rates constrain borrowers and financial institutions. None of these outcomes is automatic, and the balance of risks depends on timing, jurisdiction, and market structure. A useful framework is to ask 4 questions. What is happening to inflation? What is happening to employment and growth? How sensitive are households, firms, and banks to borrowing costs? And are market moves reacting to actual rate changes or to expectations about future policy? That framework helps connect one policy tool to many outcomes without assuming a simple one-to-one relationship. The practical takeaway is that interest rates are a transmission mechanism, not just a number on a news headline. They influence spending, saving, hiring, pricing, and asset valuation through many channels, with delays and uncertainty. If you understand those channels, macroeconomic news becomes easier to interpret and less mysterious. This is educational content, not financial, investment, tax, or legal advice.